For many young companies, it's a matter of making sure that they've got a set of investors and a business plan that allows them to capture that value of compounding over time. There's been very little that's been successful in insurance by just plugging a ton of money into a company and hoping that it works. It's much more about time than it is pumping a bunch of money in. And that's very different than most other investments that venture capitalists might have. Hi, I'm Adrian Jones, and this is the future of insurance.
Adrian, it's good to finally sit down with you. Been hoping to have you on for a while, so it's great to make this happen. Thanks for joining me today.
Glad to be here.
So for those who don't know you, they should, but give us a little bit of background on you.
Yeah, thanks, Bryan. Adrian Jones, I've been a venture capitalist in this space for the last several years, most recently at Hudson Structured Capital Management, and before that as head of Score Ventures. I actually got into this when I was in consulting way back in the day. I was told to get on a train and go down to Princeton, New Jersey and ask for a gentleman in an office there, and they would tell me what to do. And that was my intro to the insurance business. So I didn't really know much until then, but I figured it out. And so after I left Bain & Company, after almost 10 years there, I went into the reinsurance business. I was head of strategy at Renaissance Re in Bermuda, and then moved to Paris, where I was head of strategy and business development at Score. Started doing the venture work at Score when InsurTech started becoming a thing, and here we are. So.
And if people have read any of the Future of Insurance books, they'd recognize you because you're talked about in at least one case, if not a few. So yeah, you do come up, and you're in I think it was the clear cover case, if I'm not mistaken.
I remember contributing to a few of those, yeah.
Yeah. So you've had a really interesting background. I didn't know about the Paris part. I thought you were always like New York or Bermuda, so that's even more interesting. But I am curious about one thing in particular that I want to start with that you've looked at over the past. I think you do this quarterly, maybe not as frequently, but you've been looking at employment in the insurtech sector. And so often we talk about the investment side and whether it's up or down, but I think you've cleared out some of the noise on the dollars and just tried to look, well, is the sector healthy from a scale and employment standpoint? I'd love to hear about some of what you've seen, and do you see kind of mirroring the hype around the investment dollars going in or not going in, and then kind of broadening that out almost as a bellwether or like early warning sign for the broader sector of insurance?
Yeah, so about a year ago, I started adding up the headcount according to LinkedIn for about 400 companies in insurtech, ranging from very small to very large. I think Policy Bazaar out of India is the largest in terms of headcount in the sample. It includes some companies that are older and established, more software-oriented companies, and it includes some very young companies as well. What I concluded is when you add up those 400, you get to a little over 100,000 people working for them. And that's up from about 77,000 about 2.5 years ago.
Okay. Right during the pandemic.
Yeah. So that was all the further that we could go back using the data. But we found that, the trend has definitely slowed. And quite a number of companies have had layoffs, as you know. Of the companies who have fewer people as of the middle of the year when we most recently updated it versus a year before that, the average reduction was actually about 31%.
Wow.
And almost half of companies had a reduction on average of 31%.
Wow.
So there was definitely starting to emerge some fairly significant divergence in terms of headcount. What we noticed is the largest, most established companies continued to add, albeit at a very slow pace. Those in the middle, which was 200 to 1,000 people, they were actually most likely to be slowing or reducing. And I think that makes sense considering what's happened with late stage valuations.
Yeah.
And then some of the youngest companies, again, they continued to add because, they were relatively young, they were getting funded, and they hadn't yet hit the growing pains that perhaps some of their larger cousins had.
Yeah.
Or perhaps, they're companies that came a little bit later in the cycle and they realized that actually, hiring teams of hundreds of people hasn't generally been a formula for success. In fact, staying somewhat lean, this idea of lean startup that people used to talk about that then got forgotten, is kind of coming back into vogue. So those are some of the trends that we've seen. We'll update it again, hopefully at the end of the year here, and publish a new version in the new year to see what's happened.
Well, I definitely also heard about, companies opportunistically. It's like, look, that one's going through some pain. That's our chance to pick up talent we would never have had access to otherwise. Were you catching? I don't know if you didn't see individuals going from one to the other, but in terms of some of the larger trends, did it seem like there's a bit of that migration, or did it feel like people were actually just leaving the sector?
You know, we don't have enough granular data to know exactly where people are going, whether they're coming in or out of the sector. What I would say is there has been a lot of movement lately. That movement has been in all directions.
Mhm.
Startups have brought in a lot of people from outside the industry. Some of them have gone to work for incumbents. Some people have come out of incumbents to work for startups. And of course, there's the people who always want to work for a young company. And, you see a bit of a merry-go-round emerging with some of them.
Yeah.
So, this mirrors the broader patterns in insurance, right? People are constantly moving around the sector. Particularly in markets like London, and there's nothing unusual about seeing that also emerge among younger companies.
Do you think, I mean, speaking of the sector more broadly, I was asking about the sort of bellwether early warning side. Do you think that what you saw in InsurTech maybe a year back or so is starting to play out in the broader industry or the traditional players in it?
Well, you've started to see the traditional players, particularly in P&C admitted lines, with some fairly significant layoffs recently. And of course, this also be kept in perspective. It's oftentimes hundreds, if not thousands of people, but it's still often single-digit percentages of the total workforce. But still, it's meaningful because these companies are so large. So it's not surprising. We saw it happen among the insurtechs. It's not surprising that it would then happen among some of the larger companies as well. The younger companies are more fragile. They tend to get blown a little bit more when things happen, as opposed to the larger, more sturdy, solid companies that perhaps have the balance sheet that they can just kind of wait it out. So it's not surprising that we're seeing, the incumbents having more significant reductions after following the insurtechs in that way.
Yeah. One of the things that I know you've talked about lately, and actually just at ITC, is this notion of some of the companies that, I mean, you said like the more mature ones, but some of these that sort of predate even the term insurtech that maybe don't fall into the kind of narrow lens of insurtech that some people apply, but really they're quite a bit bigger. They've been successful. They're still around, and sort of analyzing them and said, well, how did they get to where they're at? And I know there are a number of companies that are trying to figure out how do we survive. So maybe there's some examples. What are some of the things that you've learned from, who are these types of companies and what have you learned from them and what you've been looking at?
So there's at least 4 companies that have been recently valued at least $5 billion or more, just in the U.S. and Bermuda insurance market, that were founded after 2008. And maybe you give Acrisure an honorable mention. They were founded in 2004, I believe. They were most recently valued at $23 billion at some point last year. So there are companies that have been successful. People don't typically think of them as insurtechs, but this is folks like Essent, for instance, in mortgage insurance. A $5 billion company based on recent market cap. Again, people don't really think about it. And by the way, these slides are all on my LinkedIn. So if you go on my LinkedIn, you can find all of the details and the data behind it. But yeah, there have been companies which have been successful. They've pursued, and I outlined in the presentation, 7 different things. So we could go through the 7 if you want, Bryan, or how do you want to take it?
Well, I mean, maybe there's some key takeaways from it. And if it is all 7, it's all 7. But if there's some that are maybe surprising or really salient.
Well, one of the points I made in the presentation is actually the technology is not the biggest differentiator. A lot of the companies started with highly experienced management teams. These are not people who are 2 years out of Stanford GSB coming in and rocking our world. They were people who actually, in many cases, were CEOs or executive vice presidents, serious senior executives at other companies. They often were getting into dislocated markets or markets that had some sort of big regulatory change.
Yeah.
The regulators in many cases were supportive of what they were doing as opposed to trying to fight regulation.
Yeah.
So it was more of a tailwind. They've also had time. a lot of the insurtechs that are out there have only been underwriting. I'm speaking of underwriting companies, so carriers and MGAs in particular, but also distributors. They've only been around for 4, 5, 6 years. That's not long enough to prove yourself.
Yeah.
Insurance is a business of compounding returns over time. And the only way that you can prove that you're great is by showing that your compounding machine works.
Right.
So you have to have time. And, for many young companies, it's a matter of making sure that they've got a set of investors and a business plan that allows them to capture that value of compounding over time. There's been very little that's been successful in insurance by just plugging a ton of money into a company and hoping that it works. It's much more about time than it is pumping a bunch of money in. And that's very different than most other investments that venture capitalists might have. So it pays for people to bear that in mind. But tech was the 7th on my list, and it was number 7. I even called it sufficiently good tech, because what I found is in many cases, companies built the insurance mechanisms first. They got those insurance mechanisms working, and then they said, okay, how do we build great tech around this?
Yeah.
As opposed to the other way around, let me build great tech and then hope that it works in an insurance context, because in many cases it just hasn't. And then you've wasted a lot of money building tech and you've already got technical debt. So I've encouraged people, take things slow, get the insurance right, build the tech around the insurance, show that you can compound returns over time. And to me, that is what has emerged as a successful formula. Now, there may be others, but just, and past performance doesn't predict future performance, but that's what I've seen.
Yeah, no, I would agree with that. I think that approach may not yield the hype that some of the later starters that did get just huge sums of capital poured into them have attracted, but it's not always been positive hype. And their business model, I mean, to your point, the compounding still hasn't begun despite all the capital that's been burned. So, who's the winner in that respect? The one who has more maybe press attention and brand recognition, but is not, to this day, still not a viable business, or the one who's worth $5 billion and built something that's sustainable? Depends. It just depends what you're going for.
If you did a 2x2 of, hype versus business success, and you did the R squared, I think you'd come up with a fairly low R squared.
Yeah. Yeah.
There's actually very little correlation, I think.
And you have to control for ChatGPT or OpenAI just being way outside, but generally.
Well, I don't think just in an insurance context.
Yeah.
Perhaps in other contexts, type matters. I don't think it really matters all that much in insurance. And even the concept of traction, traction isn't even a terribly meaningful concept here, because it's very easy to get the wrong traction and it's hard to get the right traction. And so I'd rather have a company that has less traction but has the right traction. I'd also rather have a company that has a smaller TAM but has a greater ability to access that TAM and dominate that market, as opposed to someone who says, oh, insurance is a $7 trillion market and look at how big my TAM is at $7 trillion.
Right.
No, it's not even close. Insurance is a collection of much smaller markets within that, and the key is to find one or two or more of those and dominate them.
Well, I think that's given your reinsurance background, that's a very underwriting grounded way of looking at it. That is something that you've also talked about, is the support reinsurance has provided to so much of the innovation and innovators in the industry. It's very easy to just say, well, we're all very risk averse, and so we don't like any of this stuff. But yes, but I think reinsurance has been the kind of consistent buck of that trend. That it has been an engine really of so much of the change in the industry. Now, yes, with VC dollars, but ultimately with capacity, and frankly, the clout and recognition to stand behind some of these ideas. And you've lived a lot of that firsthand. Just curious of your take on that, having been at the front lines of it.
Yeah, I spent 10 years in the reinsurance business, and reinsurers, I think, have been highly supportive. If I look at the top European, Bermuda, and North American reinsurers, I see that essentially all of them have some form of investing, but more importantly, essentially all of them have had material relationships with young companies in the sector.
Yeah.
And that could be as programs where, obviously in a program, 100% by definition gets ceded, sometimes to a captive, but, that's big premium dollars that are flowing into reinsurance from young program administrators, MGAs, MGUs. And for carriers, in many cases, InsurTech carriers are ceding 40, 50, 60%.
Yeah.
Whereas if you look at the large incumbents, some of them are ceding 1 or 2% of their premium. On average, it's 6 around the world. So when reinsurers look at this universe, they say, actually, some of these young companies, if I can get in and support them and help mold them into a type of business that I want to do business with, they're actually going to need me for a long time to come. And reinsurers, I think, have therefore been perhaps more supportive than people expected. This idea of the reinsurer veto, where reinsurers are just going to say, nope, we're cutting all these silly companies off. That didn't happen.
Yeah.
Maybe in ones or twos it has affected companies, but by and large, reinsurers have been and continue to be highly supportive of the ecosystem, and I think that's really important. What we're seeing apparently for the 1/1 renewals is it looks like the property market is clearing fairly well. So that's good for anybody that's in the property market. And there are increasing questions around what's going on in casualty.
Yeah.
But still it appears to be a relatively orderly renewal emerging in casualty. But, watch this space, particularly as casualty reserves start to develop from older accident years.
Yeah. I know we only have a few minutes left, but I wanted to get into a debate with you that we started on LinkedIn, and it's actually tied to this notion of reinsurers supporting a lot of insurtechs, because that's actually where I see this activity happening. But it's around the setup was the notion of parametrics as the savior, and that's fine, but it's not really what people need when they need coverage. And that was a position you were taking, which I get and I agree with, and I'm sort of looking at it as coverage is getting too expensive to buy, and it's still not expensive enough to provide in some markets, at least the way we're providing it now. So if you can't afford it and carriers can't afford to provide it to you, while parametric may not get you to 100% coverage, and depending on the level of parametrics you've got, it may still be catastrophic for you. If that's an affordable way to cut some of that risk, is that not an effective way to keep folks in the market? And that's, we need something, because what we're doing is not viable, but we can't simply pull out and, think that that's going to work either. So I'd love to hear more of your thoughts on why parametric's not the answer, and if you have a thought about what might be, or where we're missing.
Well, parametric can be the answer in some contexts. For sovereigns, for instance, it can be great to get money into the national treasury within days of something happening, so that the treasury can then disperse that to affected populations. And often that's done on a parametric basis. For large corporations that can weather the risk or handle the basis risk that's embedded within parametric, it can work for them. It can work in limited contexts for consumers where it's hard to assess and understand the risk, and maybe where it's something like a deductible buy down, for example.
Yeah.
Or even as an employee benefit, if there's a hurricane that comes through southern Florida, you give a benefit of a $10,000 parametric coverage to your southern Florida employees.
Yeah.
Things like that. But these are all niche applications, and they're all somewhat limited.
Yep.
The fundamental problem in most consumer and small business contexts is you don't know what the payout is going to be. And so consumers may have loss and not get paid. They might have only a very minor loss and get paid quite substantially. So the basis risk, unfortunately, makes it very challenging. And there are ways to reduce basis risk, but so far I haven't seen a lot of really highly effective ways to do that. We also have to think about distribution as well. No distributor wants to have a customer call angry because an event happened, they had a loss, and the parameter says, well, it's not actually worth that.
Yeah.
So When people can, they buy indemnity-based products because what they want is their car repaired, or they want their house repaired, or they want the lawsuit settled, or whatever it is. That's what they want. They don't necessarily want to check for an amount of money that's determined based on what happened at a weather station 3 miles away. And I think people need to really understand that the distribution matters. And unless you get the distribution in line and distributors get comfortable distributing the product, that they're not going to have a bunch of E&O claims, for instance.
Yeah.
Then if you can't get that in line, then it's really, really hard to distribute a parametric product, even if it's a great product.
Yeah.
So for all these reasons, I've argued that it's going to be a somewhat limited niche product. That doesn't mean it's bad. It doesn't mean you can't build a profitable business there. It doesn't mean you can't help consumers. You could do all those things.
Yeah.
But are you going to see some giant company coming up and disrupting insurance by selling parametric? I'm not counting on it.
Yeah. I would agree with you on both counts. I do think it's opportunistic, or like there are specific use cases and situations where that's a great application that changes the economics for both sides and makes things viable again. And I don't think it's, like Lemonade's going to put State Farm out of business. I don't think we're going to have that argument with like parametric insurer X is going to put State Farm, Liberty, Nation, like whoever, Travelers out of business. It's a different thing. So yeah, I think we're more aligned than our LinkedIn comments may have implied, but I do think something's got to change, because the way, and even if it's just the mechanisms behind some of the indemnity products, the way that we're evaluating and pricing risk, how we're deploying capital, the things that ultimately drive big pieces of the cost of the product. We can't just, limit repair networks and raise deductibles and effectively exit the market. From a consumer standpoint, that's not really covering them anymore. So the tools we have right now don't seem to be, I don't think, look viable. And yeah, parametric's not the answer for everything.
Well, let's just take homeowners, for instance. You're seeing a lot of changes in homeowners, like shifting towards deductibles as a percentage of the coverage A instead of like $500 or $1,000. In some cases, it's as high as 2%. So that's $10,000 if you have a $200,000 coverage A.
Yeah.
So, that's one. Shifting to ACV on roofs, actual cash value, so depreciated value, to reduce the amount of roofing claims and, frankly, fraud, people wanting to get a new roof because there was a hailstorm, and getting their insurer to pay for most of it. There's a lot of changes like that I think will help to make the product more affordable and, frankly, make the product better anyway.
Yeah.
Insurance is not supposed to be a warranty product.
Right.
It's not supposed to pay when things break. It's not supposed to pay when things get old and break down. It's supposed to be truly for sudden and accidental loss. And in many cases, it wasn't really being that.
Yeah.
So I think those things will help. The E&S market helps. The E&S share of the market has more than quadrupled since since the peak of the last hard market about 20 years ago.
Yep.
So excess and surplus is kind of a relief valve for offloading some of the riskiest business. And I think state regulators are realizing that, unfortunately, rates have to go up. There's just no way around it. If you want to have a viable insurance market in your state, you have to allow the price to go up, because insurers' own costs are going up. It's not like insurers, particularly in personal lines, are making money hand over fist right now. If anything, quite the opposite. And that's because in many cases, they just haven't been able to raise rates fast enough. So it's unfortunate, but plumbers aren't getting any cheaper. Lumber's not getting any cheaper. It's just things are not getting any cheaper. And so insurance has to adjust to that. And, if there are situations where people who are on fixed incomes or whatever are unable to afford the cost of coverage, then let's address that as a specific problem and challenge for the industry. Specific customer segments or groups, and find solutions for them, as opposed to trying to, limit what the insurance industry can do as a whole in ways that ultimately produce dysfunctional markets for everybody.
Yeah, it's a fair point. I know you got to run, but I appreciate the time. And I think for a lot of the stuff, it is it's moments for people to think about dynamics changing and possibilities. And you've been living at the front face of a lot of this stuff. So thank you for spending some time with us, Adrian.
Always interesting to chat with you, Bryan. Thanks a lot.
Thank you so much to Adrian for taking some time to sit down. Adrian and I have been at least connected on LinkedIn and at a lot of the same events, but only just got to meet for the first time, gosh, this past April. So like, I don't know, 8 months ago, something like that, the InsurTech Hartford event that is fast coming up again. So it's great to get him on the show and to hear some of the really interesting things that he's seeing on his, day-to-day interactions with the industry, but given this incredible vantage point and perspective that he's had from the reinsurance side, from the investor side, and really a lot of the research he's done overall. It's fascinating stuff, seeing what's going on with employment, living firsthand how reinsurers have been so crucial in the advancement of the industry on a number of fronts. And then, this sense of like, so what's next and how do we make this work going forward? Definitely we have some differences in how we think about the different components or tools we can deploy to keep this industry viable and thriving and economically feasible for both the buyers and the sellers, especially around parametrics. But there's no question what we have needs some work, needs some adjustment, needs other tools at its disposal. And I really appreciate Adrian's point on, how we can try to do that and different things we need to keep in mind, including for those who are, really unable to get coverage. And at the same time, having them uncovered is also not viable because it can destroy them financially for the rest of their lives. And that's not a great place to be either. So big thanks to Adrian for the time he spent today. I hope it gets you all thinking about where this industry's heading, what's possible, what it takes to succeed and push us forward, and what your hand can be in all of that. So thank you to Adrian. Thank you to all of you. And I hope to see you back here next time. And we will be taking a break for the holidays. So I will see you back in a few weeks. Thanks, everyone, and happy holidays.